Hello everyone. Welcome to the webinar conducted by EduPristine on portfolio management. So first I'll do a bit of voice check. If I'm audible to you all, then you can respond by typing in your chat box. If I'm audible, you can respond by typing in your chat box. If there is any problem in listening to my voice, you can mention that in the chat box or in the question box. For those who are new to this series of webinars that we have been doing, if you want to ask any question in the middle of the webinar, you can simply post it as question in the question box of your interface. So if you're having any problem in listening to my voice, you can post it in your question box or in your chat box. Our technical team will try to help you. So it seems that everything is okay with the audio. So I will continue now. In the middle of the webinar, if there is any problem in listening to my voice, please feel free to post it as a question in the question box. Right? So the topic for today is portfolio management. Portfolio management is a very important topic for CFA Level 1 exam. The weightage for this is around 10%. So you can expect a fair number of questions from this topic. So we'll try to cover these topics under portfolio management. First, we'll discuss briefly about the portfolio management process. But then we'll also look into the risk and return calculation of portfolio. And we'll try to understand how we can find out an efficient portfolio. So first of all, we'll try to understand what do we mean by portfolio. So portfolio is nothing but group of different assets. It can be stock, it can be other assets you are investing in. So why do we actually need to go for portfolio? Investors go for portfolio because they want to diversify their risk. It is sensible to invest in diverse stocks and hence spread your risk. So by diverse stocks, I mean that investing in stocks of different industries. For example, if as an investor, it would always be prudent to invest in various stocks like the technology stocks or the oil stocks, because what happens is that when in the stock market you can see that when the stocks fall of a certain industry, then you can see that pattern throughout that industry. For example, if stocks of computer industry are falling, then that pattern will be observed in all the stocks of computer industry. It's generally the trend that we can see. So to cope up with this kind of situation, we can diversify different kind of stocks. So it would be sensible to invest in both the security stocks and the oil stocks, because that way you are trying to reduce your risk. So you'll make a portfolio of different stocks in order to diversify your risk and maximize your return. As an investor, your objective is always to reduce your risk and maximize your return. Okay? So if you have, for those who have joined right now, if you are having any problem in listening to my voice, you can post it as a question. Our technical team will take care of it. Okay, now I'll proceed. So basic idea behind going for a portfolio is reducing your risk. So in most cases, you are able to reduce your risk in a portfolio unless the assets are perfectly positively correlated. We'll try to explore this term, what we mean by perfectly positively correlated, in the coming slides. Right? It's very important to understand what is correlation when we are trying to understand portfolio management. So while going for a portfolio, there are certain things that we should keep in mind. First is, what is the return expectation? So as an investor, whether we are expecting high returns, medium returns, or low returns. So this is the key issue that will drive our decision. The other thing is your risk profile. So as an investor, how much risk you are willing to take. So whether you want to go for high risk or low risk or medium risk, so as an investor you need to figure out the two main aspects, that is your return expectation and your risk profile. Based on this two factors, you are going to decide which portfolio is going to be better for you. So the asset allocation decision, which is basically building up your portfolio, depends upon two key things. First is your return expectation and the second is your risk profile. So for every investor, you will have a different optimum portfolio depending on his risk profile and return expectations. Okay. So there is always a trade-off between risk and return. So if you are going for higher return, you will have to face higher risk. So that is the basic theory behind portfolio approach, that there is a risk-return trade-off which as an investor you have to face. So your job as an investor is to find an optimum point that will give you the maximum return on a given level of risk that you are willing to take. Right? So we'll try to understand more about portfolio by the given example. Right? So suppose that you want to create a portfolio having two different assets. So asset A and asset B. The asset can be anything. It can be your stock. It can be your other kind of investment like mutual fund. Right? So there can be different kind of assets. So we have two different assets, asset A and asset B. The return of asset A is 10%, whereas the standard deviation, which is the measure of the risk of the asset, is 12%. The return of asset B is 15% and 18%. So you can see that in this case also, if asset B is giving higher return, the risk associated with it is higher. So there is always a trade-off between risk and return. So if you go for higher return, you will have to take more risk. So you definitely want to have asset B in your portfolio because it gives you maximum, it gives you more return. Having asset A in your portfolio is that it has lower risk associated with it. You also want to have bit of asset A in your portfolio. So what I have done is that I take different weights of asset A and asset B. Suppose that you have $1 million and you want to invest them in asset A and asset B. So if I have written weighted is 1, that means that we are investing all the amount in asset A. And we are constructing a portfolio in which we are investing all the amounts in asset A, as you can see here. Right? So 1 here means that 100% of your investment of $1 million is going into asset A. And if I have written it 0.9, then it means that 90% of your investment, that is $9,000, are going into asset A, and 10% of your investment, that is $100,000, is going into asset B. So your portfolio will have the following return and the following risk associated with it. So the important thing is how to calculate the risk associated with the portfolio. Then the weight of the different assets is given and the standard deviation of that asset is given, and also the correlation between the assets is correlation. What we mean by correlation between assets? So correlation is nothing but measures the spread of linear relationship values. By that we mean that how the movement in asset A and movement in asset B are related. Suppose that you have invested in stocks of Google and you have invested in stocks of Microsoft. So these two stocks can be highly correlated because they belong to the same industry, that is the tech industry. So the stocks of these two can be highly correlated because there are certain factors, underlying factors, which is guiding both the industry. So correlation measure the strength of linear relationship between two variables. So if we are saying that the correlation between two stocks are positive, we are basically implying that the stocks will move in the same direction. That is, if one stock moves up, the other stock will also move up. For example, in this case, if the stocks of Google are moving up, we'll observe that the stocks of Microsoft are also moving up because they are positively correlated. And by negative correlation, we mean that stocks are moving in the opposite direction. That is, if stocks of asset A is increasing, then you will observe that stocks of asset B is decreasing. So we'll try to figure out whether we should go for low correlation or high correlation. What is the impact of high correlation in our portfolio? If there is a high correlation between all the assets that we have identified for our portfolio, then what is the impact of that on your portfolio? So once again, okay, I'm doing a bit of audio check. Okay, is it clear? Audio is the audio clear right now? You can respond by typing in the question box. Is the audio clear? I'm waiting for your response. Okay. Okay, the audio is clear for everyone. I'll proceed. I've got positive response from most of you. Okay. So it seems that the audio is fine now. If you have any queries regarding what we have discussed or any question, you can post it in your question box. Okay. So I believe till now we are going fine. Okay. So we're trying to understand correlation. So I'll once again repeat what we mean by positive correlation. So by positive correlation, we mean that the stocks are moving in the same direction. So if you have two stocks, stock A and stock B, and if the correlation between that stock is positive, that means that both the stocks are moving in the same direction. That means if one stock rises, the other will also rise. So there is a pattern between the movement of the stock A and stock B. And similarly, by negative correlation, we mean that the stocks are moving in opposite direction. That is, if stock A is increasing, you'll observe that the stock B is decreasing. So we need to also understand what is the effect of positive correlation and negative correlation on your portfolio. So for a better portfolio, you should go for lower correlation between two securities or stocks. It will give you diversification benefit. So it is not a very complex thing to understand that if you go for a lower correlation, then you are basically diversifying your investment. Let me tell you how. So suppose that you have two different assets, asset A and asset B. So asset A is giving you 10% return and asset B is giving you 15% return. So if the correlation between asset A and asset B is suppose 0.7, which is positive, that means that asset A and asset B have similar pattern in the movement of their stock. That is, if stock of asset A increases, stock of asset B also increases. So, is it going to be better for the portfolio or not? As far as diversification is concerned, a high positive correlation won't achieve you great amount of diversification, won't give you lower risk. Because what happens is that if the market is going through tough times, then what will you observe that both the stocks are going to fall because they are positively correlated. So you will observe that both the stock A and stock B both are falling and you are experiencing high losses because you have taken stocks which are positively correlated. So you did not go for diversification of stocks because the stocks are positively correlated. So in tough times, when the market is not doing well, you'll observe that you're making losses on both the stocks, stock of asset A and asset B. But if you had gone for a portfolio with a low negative correlation, then if one stock was falling, then you could have recovered the losses by the increase in the stocks of other assets, because the stocks are negatively correlated. So as far as diversification is concerned, you should have gone for stocks with negative correlation. Okay. So in portfolio, then, so how to find out the standard deviation, that is the risk associated with the portfolio, when the risk associated with the individual asset is given, as well as their weights are given. By weights I mean in what proportion we are investing. So suppose that in this case, if I said that I have I have $1 million, right? And if I have invested 90% in asset A and 10% in asset B, then weight for asset A would be 0.9 and that for asset B would be 0.1. So obviously I have already made correlation is also going to be an important factor when you are calculating the standard deviation of the portfolio. So if you have two assets, asset A and asset B, then the standard deviation of portfolio is given by the following formula. The one which I have colored in yellow. So this is the standard. This here, sigma E square represents the variance of your portfolio. Okay. Sigma 1 square represents the variance of your individual assets in the portfolio. Here it can be asset A. Sigma 2 similarly represents the standard deviation of asset B. Sigma 2 represents the standard deviation of asset B. W1 is the weight of asset A. W2 is the weight of asset B. There is one more term. There is one more term in this, and that includes the correlation. This rho 1 to this term, that is rho 1 to, is the correlation between asset A and asset B, which in this case is 0.7, right? And sigma 1 is once again the standard deviation of asset A, and sigma 2 is the standard deviation of asset B, right? So suppose that all these terms are given, that is the weight of asset A, in this case this is the weight of asset A, this is the weight of asset A, and this is the weight of asset B. What I've done is I use this formula, this formula, I use this in Excel, right? And I calculate the application and the return. Okay. I take different weights of asset A and asset B, right? And calculated the application using this formula, and the return is the weighted average of any return. So we have a portfolio. Simply take the weighted average or So Aditya, my boy, you know, you respond by writing the question box. And once again, doing the audio check. So audible. You can respond by typing in the question box. I'm waiting for your responses. Is it fine now? Am I audible now? Yeah. So Aditya and Rajesh, I think there was some problem in your internet connection because I was getting that weak signal problem. Okay. So now I will continue. If you have problem in listening to my voice, you can post it as a question in the question box. So since the audio is better now, I'm going to continue. So what I was talking about is how to calculate the return and the standard deviation of portfolio when the return of the individual asset and their corresponding weight is given. Right? So in this case, as you can see, the weight of asset A and asset B, it's given. It's 90% for asset A and 10% for asset B. So return you can calculate simply by taking a weighted average of the returns of asset A and asset B. So in this case, that would be 0.9 into return of asset A, that is 10%, plus 0.1 into return of asset B, that is 15%. So the overall return would be 0.9 into 10, that is 9%. This will come to be around this figure, right? Similarly, for this case, so it's very easy to calculate the return of. So it is very easy to calculate the return of the portfolio when the return of individual assets are given. For standard deviation of the portfolio, we'll use this formula that I have already discussed. I hope all of you have understood this formula. In case any of you want me to repeat this, you can put it as a question. I'll repeat it. If you have any problem in understanding how to calculate the variance of the portfolio by using this formula, you can post it as a question. I'll go through it once again. So if any of you want me to repeat this, okay, it seems you have got a fair understanding of this, how to calculate variance of the portfolio when the variance of individual assets, their weight, as well as the correlation between the assets are given. We'll look at some of the questions from this. You can expect questions like this in your CFA exam. So this is very simple question in this one. As you can take a look, we have to calculate the expected return. So the total investment is $1 million, right? So the total investment is $1 million. The rate of equity is given as 40%, debt is given 25%, and commodities is 35%. So we have three different assets. The asset one is equity loan. Okay, its rate is given 40%, that is 0.4. Asset 2 is debt, 12 is 0.25, that is 25%. And asset 3 is commodities, rate is given as 35%. The return on all these assets are given. So your return on equity is 15%, return on debt is 8%, and return on commodities is 11%. So how to calculate the expected return of your portfolio? So we'll simply take the weighted average of the return. So in this case, we'll take the weight of equity, that is 0.4. We'll multiply it with the return of equity, that is 15%. We'll once again take the weight of debt, that is 0.25, and multiply it with return on debt, that is 8%. We'll take the weight of commodity, that is 35%. We'll multiply it with return of commodity. So it is come out to 11.85%. So your portfolio will give you an expected return, that is 11.85%. So as you can see, this return is higher than the return which you would have got by investing only on debt, and the return you would have got by investing only on commodities. But it is less than the return that you would have got by investing only on equity. So some of you might think that why will we invest in this portfolio if it is giving us lesser return than what we would have got if we invested only in equities. So the answer lies in the fact that since you are going for portfolio, you are minimizing your risk. Although you are getting lower return than what you would have got by investing only in equity, but you are minimizing your risk. Since equity is very riskier, so you don't want to take that amount of risk. You want to lower down your risk. So for that, you are investing in debt and commodities, right? So that captures the basic idea behind going for a portfolio. That is to diversify, to minimize your risk. Right? So this is another question. Take a look at this. I hope I am audible right now. Okay, you can give positive responses so that I can carry forward without worrying about the audio quality. So I hope you okay. So I hope that question was clear to you all, right? So I am moving to the next question. You can expect this kind of question in the CFA level 1 exam, right? So the next question is, So we have been given a portfolio which has $30,000 in equity and 20,000 in bonds. The correlation between the two assets is 0.7. And we have also been given a table. We have to calculate the expected return. Right? So we have investment of 30,000 in equity, and it is giving us a return of 13%. And the risk associated with this equity is 20%. We have made another investment of 20,000 in bonds, and the returns it is giving is 10%, and the risk associated with the bonds are 10%. So you can see equity is riskier than the bond, but it is also giving you higher return. So basic concept in finance is that higher returns is always going to come with higher risk. So returns and risk are positively correlated. If you go for higher return, then there is a higher risk associated with it. As you can see, equity is riskier than bonds. Standard deviation is the measure of risk, right? So the standard deviation for equity is almost twice, so exactly twice the standard deviation of bond. So in this case also, to calculate the expected return, we'll take the weighted average of the return. So in this case, we have to calculate the weights of asset, weights of equity, and weights of bond. So our total investment is $30,000 plus $20,000, that is equal to $50,000, right? So out of that, they have invested $30,000 in equity. So the weight for equity is 30 and the weight for bond would be 20,000 divided by total investment portfolio, that is 50,000, and that would come out at 3.4. So we calculate the expected, will multiply the weight of equity, the return of equity, that is 13%, right? And will multiply the weight of bond with the return of bond, that is 10%. So and the sum is 2 results. So the expected return 11.3%. We can find this in dollar value terms by multiplying this expected return with the total investment in the portfolio. Right? It's 50,000. So multiply 50,000 with 11.8%, which is our expected return, to find the dollar value of our expected return. Right? To calculate the risk, I'm looking at standard deviation of the for this, we copy the correlation between the two assets which is given to me as 0.7. So we already know the rate of the equity, which is 0.7, and the risk, that is correlation of the 20%, and 0.8. We'll use the formula and according to it. Okay, so the formula I already mentioned. So rate of equity, we have standard deviation of equity, we have rate of bond, the standard deviation of bond, we have correlation between them, and we define the risk associated with the portfolio. If you find very broad value, then we multiply the investment in the portfolio with the risk associated with the portfolio, which comes out to be 0.1507, right? So if you want me to repeat this question once again, you can respond by typing in the question box. If you want me to proceed, you can also respond by typing in the question box. So I'm waiting for your responses. Okay. So Aditya has asked a question. He wants to know whether when two assets are perfectly positively correlated, that means rho equal to 1, the expected return is the same as the rest. Okay. So expected return and risk are two different things, Aditya. Expected return won't be same as the risk, okay, if they are positively correlated. As you can see, you can use this formula, you can put rho as 1 in this case, then your risk will come out to be the weighted average of your risk. That is the standard deviation. So if your assets are perfectly positively correlated, then the standard deviation, that is the risk of the portfolio, will be equal to weight of asset 1 into standard deviation of asset 1 plus weight of asset 2 into standard deviation of asset 2. Right? Okay. So I hope you got it, Aditya. We are using this formula to calculate the standard deviation, that is the risk of the portfolio. And even if we put the correlation as 1, the risk and the expected return of the portfolio will be two different values. It won't be same. Okay. So Aditya, if you got it, I'll proceed now. Okay. So I'm going to proceed now. There is one more question. So in this case, this is a very simple question. It follows from the previous question. We have been given the standard deviation of asset A, that is 55%, and for asset B, it is 85%. In this case, the only twist in this question is we have not been given the correlation. Instead, we have been provided with the covariance of asset A and asset B. So as you know, the correlation of asset A and asset B is equal to covariance of asset A asset B divided by standard deviation of asset A and standard deviation of asset B. So in this case, we will first find out the correlation between asset A and asset B. And how to do that? You will use the covariance and the standard deviation of asset A and standard deviation of asset B to find the correlation between asset A and asset B. And then you will use the formula for variance of a two-stock portfolio, and you will calculate the variance of the portfolio. So was this question clear to everyone? If this question was clear to you, you can okay, I'm waiting for your responses. This question was clear to you. You can post your reply in the chat box or question box. Okay. So it seems that this question was clear to most of you. Right? Let's proceed further now. So in this case, we have been given two scenarios. Actually, we have been given two stocks, stock A and stock B. There are two stocks, stock X and stock Y, and there are two scenarios, that is A and B. Okay. The probability of scenario A happening is 0.6, and the probability of scenario B happening is 0.4. The return of stock X in scenario A is 30%, and the return of stock X in scenario B is 15%. Similarly, the return of stock Y in scenario A is 15%, and the return of stock Y in scenario B is 7.5%. Right? So we have to calculate the covariance between the returns of stock X and stock Y. So this is related to your statistics, but it is also very important in portfolio management. Okay, so we will be able to revise our concept of statistics also here. So in this case, as you can recall, that the covariance is first we'll find the mean of stock X returns. So we'll simply multiply the probability of scenario A with the stock X return, and then multiply the probability of scenario B with the stock X return and take the sum. So the mean of stock X returns is 0.24, that is 24%. Similarly, we'll calculate the mean of stock Y return, and that will be probability of scenario A into stock Y return plus the probability of scenario B into stock Y return in scenario B. So that will come around as 0.12, that is 12%. To find the covariance, we'll multiply the probability of scenario A into stock X return minus the mean we have calculated. Similarly, we'll do the same thing for stock Y. Right? So this is the first of this 0.6 is the probability of scenario A. Right? This 0.3 is your stock X return in scenario A, and this 0.24 is the mean of stock X return. Similarly, this 0.15 is the stock Y return in scenario A, and 0.12 is the mean of stock Y return. Okay. 0.4 Similarly, is the probability of scenario B, and 0.15 is the stock X return in scenario B, and 0.24 is the mean of scenario B. Is the mean of stock X return. Okay, so this is basically the formula of calculating the variance, covariance of stock X and Y. Okay, you must have done it in your statistics, right? Okay. If you want me to proceed further, please respond. If you want me to repeat this or if you have any question, you can post it as a question. Okay, I'm waiting for you, Mr. Okay, I'll proceed now. So we'll discuss a bit about risk aversion. So what we mean by risk aversion is that the investor prefer lesser risk. So if you are a risk aversion, it means that you don't want to take too much of risk and you want to keep the standard deviation of your portfolio as low as possible. So if you are a risk averse investor, you will choose a stock with higher return from two stocks with the same risk. But from two stocks with the same return, we choose one with a lower risk. For example, so suppose if there are two stocks, stock A and stock B, and they are giving the same return of 15%, we choose one which is having lower risk associated with it. Okay. So we'll try to example our discussion here. In this case, different rates of asset A and asset B, we calculated for that rate, right? Okay. So this may be better. So this is the selected one for the asset. Right? So for a good solution, there are two different kind of returns. Since this curve is like this, so for a point here on standard deviation, you can see you will get two different returns. Suppose that you are going to 15% risk, then you are getting two different returns, right? You can observe that clearly one return is superior to the other return at the same level of risk. So as a smart investor, will obviously go for that combination of rates that is going to give you a higher return, right? So at the same standard deviation, I'm once again going to repeat this concept. So I'm going to repeat the whole thing. What we did, we took different rates of asset A and asset B. We found out, we already know the correlation between asset A and asset B, that is 0.7, right? We found out the standard deviation and the return for different rates of asset A and asset B in our portfolio. We plotted a scatter plot. We observed the interesting phenomena, and that is that at every level of risk, you are getting two different returns. One return is superior to the other return. So as a smart investor, you will choose those returns which are superior. Since because at the same level of risk, you are getting higher return. So all those points which are lying with a color purple are your efficient frontier because they are giving you higher return at a certain level of risk. So all the points in colored with blue, we are not going to consider because they are giving us inferior return. We already have some points. These points are nothing but different weights of asset A and asset B. So the difference between the purple point and the corresponding blue point is that you have taken different weights of asset A and asset B in purple. So for example, in this case, the weight of asset A could be 60%, and in this, the weight could be 30%, right? So since the weights of asset A and asset B are different, your corresponding returns are different. But your standard deviation is the same. So as a prudent, as a smart investor, you choose the one with the higher standard deviation. Right? Okay. So what an interesting. So this was all about efficient frontier. Okay. If you have any questions regarding this topic, you can post it in the question box. Right? If you want me to continue, if everything is fine with the audio, you can also post it as a question in the question box. I hope everything is fine with the audio. Okay. Okay. If you have any problem in listening to my voice, you can post it. Since everything is fine with the audio, I'm gonna proceed. So I'll give one example to show that if the correlation between the stock is higher, then the standard deviation of the portfolio is going to be higher. So in this case, the expected return of asset A is given as 10%. The standard deviation of asset A is given as 20%. The expected return of asset B is 10%. And the standard deviation is 20%. So we have also been given different cases. Base of asset A and asset B is 50%. Right? And in different cases we have different correlation between asset A and asset B. In first case the correlation is 1, that is they are perfectly positively correlated. In second case it is 0, and in third case the correlation is -1, that is they are perfectly negatively correlated. So the variance of portfolio we have calculated for this different cases, and we found out that the variance of the portfolio is highest when the stocks are perfectly positively correlated. In this case, the variance comes out to be 0.04. Okay. That means your standard deviation will be the square root of this term, which will be 0.2, that is 20%. So you are seeing that if your stocks are perfectly positively correlated, you are not able to minimize the standard deviation, because standard deviation for both the stocks is 20%, and the standard deviation for portfolio is also 20%, right? So the one important thing to note is that if stocks are perfectly positively correlated, that is, the correlation between them is 1, when you can't diversify the stocks, the standard deviation of portfolio can't be reduced. But in this case, we have observed that the standard deviation remains the same at 20%. So, one important concept that is highlighted in black is the higher the correlation between stocks, higher will be the standard deviation, and hence higher the risk associated with the portfolio. Okay? So, this brings to an end to this webinar. If you have any question, you can post it as a question. Okay. You can respond. If you have any question related to this topic, you can post it. You can visit our website, that is www.edupristine.com, for free materials as well as courses on CFA, FRM preparation. We also have courses on financial modeling. I'll mail you these slides. They contain questions for your practices. Okay. You can try this. We have some sample questions for practice. If you have any problem in that question, you can contact me or mail me. I'll mail you this PPT. Most of the things that is given in this slide, I've covered it. If you want me to cover any other topic, you can post it as a question, or you can contact me. I'll try to cover it in my upcoming webinar. You can visit our website www.edupristine.com. I hope this session was useful to you guys. Okay. You can also give feedback of this session. I'm waiting for your responses. Thank you, Bernadette. We'll try to cover the topics of your interest. You can contact us, you can mail me. I'll send you this PPT. So I hope you are all preparing for CFA level 1 examination. Right? Okay. The day I'll mail you the PPT, you'll get an email ID. Okay. You contact me on that email ID. It was very great interacting with you guys. I hope the session was useful to you. Keep visiting our website. We have got lots of we have a quizzes for the exam. So interested in finance, you find our website that is www.edupristine.com. As well as the link of our website. Thank you for attending this webinar and your patience.